Hello, everybody. Welcome to another installment of our Southern California housing market update. My name is Stephen Meade with Domicile real estate for people who love houses. And you'll notice I am wearing a hoodie. Why am I wearing a hoodie? Because it is absolutely hoodie weather here in Southern California today. It is December 14th, 2021, though actually the sun has just come out. So I think we might be nearing the end of our rainy day. And that's kind of gotten me thinking a little bit about the market as a whole. And somebody came up to me and asked me a question. They said, will it get better? And my answer was, well, better kind of depends on where you're standing, right? I think if you're a seller right now, things are pretty good, right? I don't know how much better you want them to be. At the same time, if you're a buyer, I'd imagine you're very much looking forward to a world where things are better. And these are some of the thoughts that I've thought about. The nature of the real estate market is cyclical. I have been around basically, I was always interested in real estate as a kid. I've lived in Southern California since 1989. So I've seen several cycles, real estate cycles. And, while these cycles might have different magnitudes, there always is some ebb and flow. I think with that said, you can't ignore some of these macroeconomic factors. And the reality is we are in a housing crisis. There is not enough housing, meaning households are forming faster than the property base is being augmented here in California. In fact, I think that's an issue in a lot of parts of the United States right now, but it is especially acute here in Southern California. And a big part of that is for a variety of reasons. We have not built as many houses as we have needed to since 2008. I think the building industry pretty much was halted, and then a combination of having a bit of a hangover from that, as well as increased regulations, has resulted NIMBYism, a whole bunch of things, right? We've got a big list of reasons why we don't have enough houses, but the reality remains we don't have enough housing. So I think if you're a buyer, I can see how this might be a little bit of a scary time, right? If you're not somebody who's entered into that market, you're wondering, do I wait and things are going to get better? If I buy today, is it going to feel like buying in 2007 where I'm going to immediately regret it? And there's going to be some big market correction. And the thing that I tell the people like that is, I won't say that that's impossible. I think anybody who says they can accurately predict the real estate market is lying to you. I don't think it's very likely, but I also think even if that did happen, anyone who bought their home in 2007 and still has it today is probably happy. Interest rates have gone down since then, so not only is their house worth more than they paid for it, but also their monthly payment is less than it was when they bought it. And meanwhile, they probably make more money. So I think you kind of have to have a global perspective. Do I think things will get a little bit better? Of course I do. As I said, this market ebbs and flows. I just can't tell you when that's going to be. And if you're a seller, things may not necessarily be better for you. Things might be worse. So you kind of have to look at these things. We do these weekly updates because I think the reality is that's really the only ability that you have to make these decisions. I think we'd like to all think that we can look at the real estate market 20 years out, 10 years out, even 5 years out. But there are a lot of things that could change between now and then that might alter those projections. So instead, I like to look at where the market is today and make the very best decisions that I can make today based on what I want to do. So with that said, let's look at the data for making decisions today. All right, so here is really the story of our lives. Inventory. This is our total active listings. We've got it divided into two categories: under $1 million, signified by the blue line, and $1 to $2 million, signified by the red line. And I just, again, I want to point out, just what a big difference we're seeing. We are in the middle of December. Look at where this total active listings is versus the beginning of last year. It's not looking good. We are a good 20% below for under 1 million inventory. And then down here, if you look at our 1 to 2 million, I'd say we're more like 25% down inventory versus last year. My short-term prediction, this means that we will be looking at a pretty gnarly spring if interest rates remain low, or a gnarly spring for buyers. I do think it'll be a pretty good spring for sellers. Of course, if you are selling and buying something else, that's kind of a bit of a zero-sum game for you, right? Because you're gonna see the flip side of the low inventory when you go to buy. If we look at our 14-day new listings, this one I think is a little bit of vindication. One of the things that I have talked about, right, is that holiday weekends are tough. Consumer behavior is a little irrational during a holiday period, or rather a little bit unusual. Maybe it's not irrational, but it's exceptional, right? And if you look here in our new listings, right, this is the new listings that have come up in the last 14 days. So remember, this means that this is all post-Thanksgiving data right now. Our new data point is post-Thanksgiving. If you draw a line like this, you actually see like a curve that kind of seems to fit, right? We just had this kind of weird period where things dove and then rebounded. Same thing over here. You can watch the trend line go. So, listings have rebounded a little bit, but still bear in mind, we're looking at new listings. We're at about the same level as we were at the beginning of the year. That's what level listings are coming on the market. Not entirely unusual for this time of year, mind you, but not really helpful when we see this total active listings continue to drop. Now, the flip side, if this is our supply curve, economically speaking, our demand curve is new escrows. And you'll notice that these two have rebounded a little bit, but maybe not quite as much as we would have expected. I think a big part of this is not necessarily slackening demand. I think it is we are in an inventory constricted market. Buyers are out there. They simply don't find anything that they want to buy or are able to buy. We are running out of listings to purchase. So you'll see it has rebounded a little bit. But part of the reason why it's not rebounded more is basically because I don't think we have enough listings for people to buy. We're looking at sort of, beginning of the year level of inventory right now. Now, if you look at our absorption rate, what has that done, right? That's actually caused our absorption rate to drop, though I'm not really sure it's as much of a drop as you might think. If you look at where we were pre-Thanksgiving holiday, right around low 90% area for under $1 million, and maybe high 90% area for our 1 to 2 million category. If you turn around and look at where we are now, well, we're a little over 100% for our under 1 million and over 90% for our 1 to 2 million. I don't really think these are terribly big drops. These are still much higher numbers than we've seen all year. Make no mistake, this is still a very active market. Don't think because new escrows is not rebounding as fast as we would have expected, don't think that that is a soft market. In French, when you learn to speak French, there is a term, and the term is faux amis. And what it basically means is it means false friends. And it is words that sound similar in English and French, but do not mean the same thing. And I think that's actually what we've got going on here a little bit. I think if you were to look at this absorption rate graph, you might think, hey, the market is getting less competitive. I don't think that is true. I think we just had some extraordinary results because of the holiday and a lack of new listings coming on. We're seeing a flood of new listings, but it's really not enough. These are still very hyper competitive absorption rate numbers. If we go here to our closed prices, remember, this is like looking in the rearview mirror, 4 to 6 weeks. We did have that crazy dip as a result of our calculating, but it rebounded right back up. And you look at the shape of these curves, right? I think what you see is that upper end of the market is not seeing quite the level of appreciation. Our median is doing pretty good, and our entry level has done very well in terms of appreciation. Not entirely unexpected. This is our still active after 14 days on market. We saw that spike and then it has crashed down. What this means is that our market is heading into a more competitive period. When you noticed that in the spring it was the most competitive, then it slowly got less competitive, and then in the fall it's gotten a little bit more competitive again as inventory has dried up. And then if we look at our list to close ratio, what we're seeing here is there's a little bit of a falling in our under 1 million, but we're not getting anywhere close to that 100% mark. This is, and look at where we were about a year ago today. We were much closer to that 100%. I think what we're seeing happening is, this is just another indication that 2022 in the spring, at least, if interest rates hold, it is going to be more competitive than spring in 2021. I know that's a hard thing for people to fathom, but the way we're seeing it is inventory is definitely looking worse. Our market is looking more competitive. If you are a seller, this is great news. It means if you thought you missed your chance, you have not missed your chance. You will get a second chance for kind of a bit of a complete bull market for homes, I think. I think you're going to see that buyers will be clamoring for new inventory in the spring. Now, if we look at our days on market, you notice that number did spike a little bit, and I said it would probably come down. It came down a lot for our 1 to 2 million. It hasn't really come down as much as I would have expected for our under a million. But just bear in mind, remember, go back to a year ago, almost a year ago today, we were close to 40 days on market for under a million. Today, we're mid-20s. Right? Yet another indication that the following spring that we are being set up for is going to be more competitive than the spring we saw in 2021. So if you're a buyer out there, and I've been telling you this probably for a couple months, and it's not just because I want to sell a bunch of houses. I've been telling you, if you're waiting because you think it's going to get better in the short run, I don't think it will. I don't see any evidence saying it's going to get better in the next 6 months. Again, interest rates are a total wild card on this. Other external factors, the new variant of COVID, there are kind of a lot of things that could upset that balance. But as I'm seeing it right now, we are setting ourselves up for a very competitive spring. This is kind of our bellwether measure of, is our market going hysteric, or is this a rational response? You see we're trending I think probably 117% for our affordability index. Just as a reminder, 100% is our baseline set in June of 2018. And this is measuring the payment on a median priced home. I think going up 17% or so in the past 3.5 years, I don't think that's an unreasonable amount of payment gain. I think our market can absolutely absorb that. Now, if we start heading 120, 130, I don't know, that starts to look a little different to me. But given where CPI was the highest it has been in decades, this is not a scary number to me. I think this is exactly tracking where I would expect our market to track. I'm very curious to see what will happen, though, in the spring with the lack of inventory. And then finally, we have our prevailing mortgage rates, right? They've really been kind of in this 2.75 to 3.25 pocket. Maybe today we're right around 3 1/8. Again, it's not rates going up that concerns me. It is the speed with which rates go up. And if this is a gentle incline, I think our market can start to absorb that without price corrections. If it is a huge jump, all bets are kind of off. We're in such an inventory deficit. There's a lot of demand to be wicked away, right? I think if the market got softer even a little bit, buyers would rush back thinking now's my chance to get something. I hope you guys have enjoyed this. I know we're leading up to the holidays. A lot's going on. You're probably not thinking about buying or selling a home, but you should be. I think it's great to be thinking about that when other people are not. I think anybody who's putting their home on the market right now is going to have a great experience of getting an offer quickly, which is not usually what we tell people in December. Anyhow, I think that's it. All I have for you. Questions, comments, as always, we love them. We try to respond to them. If you're looking to buy or sell real estate in Southern California, we would love to help you out and give you our expertise and help you make great decisions. And then finally, do not forget to like, subscribe, and smash that notification bell. That's how you know when we have new videos that come out. And we will see you again later this week for our architectural video. Have a great week, everybody. We'll see you soon.